What's up guys, this is Danny from Rethink Peer-to-Peer Lending. Welcome back to another video on my channel. Don't get it twisted, today's video is not a clickbait attempt. I am in fact returning to Mintos as an active investor for the first time since early 2020. Due to suspicious shareholder transactions, questionable actions and a bad portfolio performance in the past, I decided to exit my investment on Mintos at the beginning of 2020, while more than 1,000 euros are still in debt collection at this point in time. In a way, my Mintos comeback has less to do with Mintos itself, but rather with the investment offer by an Estonian company that I have been following closely for quite some time now and that I was able to get to know even better during my recent stay in Tallinn. This company is an Estonian fintech called Esto, which was established back in 2017. After being on the Mintos platform since 2019, Esto is now offering a fractional bond on Mintos, where I have invested 4,000 euros myself. If you want to find out more about Esto, its operations and how they managed to lure me back to Mintos, then stay tuned, I will discuss everything in a second. To start off, let's take a closer look at Esto's business model and the company's financial situation. Esto's business model is quite easy to understand. At its core, the company seeks to facilitate payment processing between merchants and their customers in an e-commerce environment. To do so, real-time payments are offered on the merchant side and a variety of different credit products on the customer side, including short-term consumer loans, buy now pay later solutions and credit lines. The loans are financed through a mix of equity, subordinated loans, bank loans, bonds and peer-to-peer loans. Regarding the peer-to-peer financing, Esto has been working with Mintos since September 2019 to finance a significant part of their loan portfolio. From more than 70 million euros of outstanding loans at the time of June 2024, the Latvian marketplace accounted for 19 million euros alone, which is around 27%. For first-time customers, there are initial limits of 4,000 euros for credit lines and 5,000 euros for consumer loans. According to information provided by Esto, the company has currently a customer base of 550,000 people. Considering a population of 6 million people in the Baltic region, this seems to be an impressive number. Next up, we look at the monetization and how Esto is actually earning money. Esto's revenue is largely made up of interest income, which is charged to borrowers. In addition, Esto managed to generate 2.7 million euros of revenue from other fees, which include processing fees, premium subscriptions, and fees for instant repayments. Overall, Esto earns around 90% of its revenue through its loan offerings, while only around 10% is generated with B2B merchants. With regard to Esto's profitability, those numbers can be traced back to 2020 through their investors relations page. According to those numbers, the Estonian company has been consistently profitable since 2020 and has generated a net profit of at least 800,000 euros every year, while the best result came in last year with 2.85 million euros. If we take the most recent numbers of Q2 2024 into account, Esto has now been profitable for 22 quarters in a row. A look at the company's balance sheet also shows some impressive KPIs. As Esto was financed with debt capital from the outset, the aim was to become profitable as quickly as possible. The entire equity on the balance sheet was therefore self-generated and has been increased to up to 8.7 million euros in recent years. The equity ratio has also improved over the years, while KPIs such as the liquidity ratio and the debt to equity ratio are also in a strong and healthy range. Now let's have a look at how investors can actually invest in assets by Esto. Esto has been working with Mintos since September 2019 and finances up to 30% of its loan portfolio via the Latvian marketplace. It is therefore fair to say that the partnership has grown historically over the last 5 years. According to Esto CEO Mick Metzer, Mintos has become even more professional after obtaining the investment brokerage license, although this has also increased the bureaucratic requirements for financing new assets. The first option for investing in Esto assets are private and unsecured consumer loans from Estonia or Lithuania. The interest rate on these loans is often in the range of 8 to 10%, while they are backed with a buyback guarantee from Esto. Important to highlight is the fact that Esto has always honored their obligations towards investors and even in times of the pandemic has never implemented any loan extensions or pending payments. Given its strong financials and good repayment behavior, it seems obvious why Esto owns one of the highest ratings on the Mintos risk score among all other lenders. As of this month, Esto has also issued a fractional bond via Mintos to invest in. The bond comes with a term of 3 years, a coupon rate of 10.5% and a quarterly distribution of interest payments. Esto plans to initially offer up to €1 million on Mintos, but with the opportunity to increase even to €6 million should there be sufficient demand from investors. Speaking of demand, many of you will likely know by now that I have established a German Telegram group in the past where investors get exclusive information for when there are any happenings in the peer-to-peer space. As of this week, I decided to open up 2 English channels as well, one being on Telegram and the other one being on WhatsApp. So if you want to get quick summaries with updates from the industry directly on your phone, I highly recommend you subscribe to those channels. Next up, let's review the Esto approach for risk management. When it comes to lending money to private customers, Esto relies on 3 different risk assessment levels. Firstly, the acquisition of borrowers only occurs during the active purchasing process in the commerce environment and not in the case of an occasional loan application where the procurement of funds is not directly related to a transaction with the retailer. Secondly, the data provided by the borrower must be publicly verifiable, as the information provided by the borrower alone cannot be trusted. And thirdly, gradual risk management. This includes what I mentioned earlier, namely that a larger loan amount is only increased through positive repayment patterns. According to Esto CEO Mick Metzer, these 3 factors form the pillars of risk management to predict 90% of borrowers' repayment behavior. The remaining 10% can be optimized at various other points. In terms of recoveries, Esto doesn't deal too much with borrowers who are unwilling to pay, but instead forwards these cases to external debt collection agencies. This means that loans that are up to 90 days late are still processed by the local teams, whereas loans that are more than 90 days overdue are sold to external debt collection agencies. According to CEO Mick Metzer, the average discount is around 60%, which is in line with the market average. On the other hand, Esto's historical default rate is quite impressive, which is said to be less than 2%. Esto's market experience, profitability, repayment behavior, and transparency can be considered their biggest advantages. On the other hand, it was difficult to identify any real disadvantages. The somewhat low interest rate could be mentioned here, but obviously this is a direct consequence of Esto's good reputation. If you want to find out more about Esto, I recommend you read my detailed analysis on the blog, where you can find additional information about the company. Within the review, you can also find a link to the podcast with Esto co-founder and CEO Mick Metzer, with whom I spoke to in Tallinn at the beginning of June. Guys, there are many more videos in the pipeline for the upcoming weeks, so please do me a favor and consider subscribing to this channel if you haven't done so already. Thanks for watching, and I'll see you in the next one. So long. Bye bye.